We'll start now. It's 12 noon sharp, and good afternoon and a warm welcome to you all from Silicon Valley. I hope you all are staying safe and healthy amidst this pandemic. My name is Nilesh, and I represent the San Francisco chapter of the Institute of Chartered Accountants of India. It's very nice to see so many people online on a Sunday afternoon. It's a warm, sunny, bright day here in Silicon Valley, and I know it takes a lot of willpower to be not outdoors and enjoy and soak in the nature. I commend all of you for spending time with us on a Sunday afternoon, discussing taxes. So thanks a lot. Here we are. It's the first event of the San Francisco chapter in 2021. And the topic is income tax regulations and changes relevant to non-resident Indians with a special focus on the United States. Before I actually begin today's session, let me share with you a little bit of chapter updates. As many of you know, the San Francisco chapter of the Institute was established in 2017. In a very short span of time, the San Francisco chapter has taken many initiatives to deepen and strengthen the community of chartered accountants, not just in San Francisco, but all over the United States. Many of you may also be aware that the San Francisco chapter has been at the forefront of expansion of the ICAI footprint in the United States. As of now, San Francisco chapter has actively supported the establishment of 5 representative offices of the Institute and 5 chapters of the Institute in the United States. And thanks to the unstinting efforts of the San Francisco chapter, today, ICAI is present in 11 locations in 15 states all over the United States. The regions are San Francisco, New York, Houston, New England, Washington, D.C., Chicago, Atlanta, Dallas, Florida, New Jersey, and Seattle. Interestingly, in the coming few months, the San Francisco chapter will also actively support the inauguration of 5 more representative offices in Arizona, Los Angeles, Michigan, North Carolina, and Ohio. And to top it all, in the next 60 days, we will see a national office for ICAI US inaugurated right here in the Silicon Valley. So lots is happening, expansion is taking place. This is all just to benefit all chartered accountant members. So stay connected. On the topic of the new chapters, let me also announce that the inaugural Chicago chapter event is taking place on April 24th, and the inaugural Dallas chapter event is taking place on May 22. So do join for us for those events. Please take this as a personal invitation from our side, and join us for those events as well. Another one very big announcement that I need to make, a major initiative that is likely to see fruition is the launch of an exclusive executive education program customized for chartered accountants. The ICAI US team is actively coordinating this program's launch with a top-of-the-line Ivy League business school and the institute in Delhi. It's going to be a very interesting program. Trust me, guys, it's going to be something which all you chartered accountants will be very keen to have on your LinkedIn profiles and your resumes. So do watch out for that. We will be coming back to you with more details. At this stage, it's work in progress, so we can't share anything. On the topic of connection and connectedness, let me also mention that if there are any chartered accountants in audience today who are still not members of our platform, then please do reach out and connect with us. Visit icai.us, and I repeat, icai.us. Share your contact details with us, and our membership team will be more than happy to coordinate with you and get you onboarded. Let me say that our membership team, and not just our membership team, our entire chapter team is extremely responsive and works towards helping all members, all chartered accountants, no matter which part of the United States you are based in. So do reach out to us. There are multiple ways that you can communicate with us. There is a WhatsApp group, which is very active, an active Telegrams group, a very robust LinkedIn group. So there are a variety of ways in which you can interact with us, share your knowledge and learn from us, and also share what's happening with you. So please, once again, take this as a personal invitation and join us. One final chapter update before I actually start today's event is that on April 17, just 5-6 days from now, we are hosting one more very interesting event. I will be moderating a panel discussion on the $1.9 trillion American Rescue Plan Act. We will be having eminent experts like Sanjeev Gupta, CPA, and Dan Cross from Eisner-Emper, who will be participating and answering questions. So if you feel this is of interest to you, or if you know of somebody who could be benefited from the proposals of the American Rescue Act, do attend and join in and ask us questions about that as well. So with the chapter update out of the way, let us start. As you know, my name is Nilesh, and I am a chartered accountant by training, but investments is my passion. And like many of you on the call, India is at the centerpiece, and India is still intertwined in my lives. Whether it is financial investments, real estate holdings, business interests, personal families, relationships, social connections, India is still intertwined in many ways. And I'm sure that's true for you as well. But what happens is that when you are so intertwined with India, you also have to deal with Indian taxes. I'm sure that's one part of India which none of us would want to have anything to do with it. But, guys, there is no escape from death and taxes. So we've got to deal with this. This is a reality which we have to face. And let's face it, when I immigrated from India to the United States, I had to deal with a complex maze of banking regulations, income tax rules, compliances, immigration challenges. It was complex. Now, as a chartered accountant, I'm trained, and hence I could deal with all that complexity. But for somebody who's like an engineer or a software expert or a doctor, all these laws and all these taxes may seem daunting. And to add to this complexity, there have been many changes on definitions and regulations and banking systems in the last few years. So what do all these complexities mean for you? What are the challenges that you're going to face? And these are exactly the kind of questions we want to address today. And we are lucky. We're lucky to have people like Neeraj, Bhatia, and Sanwar, Harshwal with us. Both of them are dual qualified chartered accountants. So what I mean by that is they not only hold an Indian chartered accountant degree, but they also have a US CPA. And interestingly, they both have centers back in India. And guys, trust me, that's the real deal, because you want to listen to somebody who understands both the ecosystems, India as well as the United States. And both these gentlemen have extensive understanding of the space. So we're lucky to have them. Before I actually start shooting questions to them, I would like to invite them to talk a little bit about themselves, spend a minute to share their experiences and perspectives, so that when you ask them questions, you better understand them. Over to you, Neeraj, if you can share a little bit about yourself.
Good morning, everyone. I'm Neeraj Bhatia. I passed out my CA in India in 1983. I also did my cost accountancy at that time. And I started my practicing firm in India by the name of Neeraj Bhatia and Company, which is still operating. My younger brother is handling, and we have a staff over there, and that's in Delhi. And around 99, 2000, I moved to US. Then I started Bhatia and Company, and we are a full service accounting firm both in India and here. In US, we have two offices, one in Pleasanton and one in Santa Clara. And so that's briefly about me. And I also, while I was there, I also did LLM in international tax in 2006. So welcome everyone over here for spending time to listen to us. So hope whatever insights we share will be useful for both for all of us. Thank you. And over to Sanwar.
Hi guys, my name is Sanwar Harshwal. As Neeraj said, I have been chartered accountant and was practicing chartered accountancy until 2000 from 1985. I was practicing in Bombay, originally from Rajasthan. In US, I worked for some other CPA firms like Deloitte, Moss Adams for 8 years. Started my own firm in 2009. Currently, we have 3 offices in US and one in Jaipur. We conduct close to 160 audits every year, and we have several tax clients of different nature. And I like to thank our chapter and Nilesh for putting really good introduction. I took my COVID shot 3 days ago, and still I am kind of little bit impacted. So my voice is going to be a little bit shaky, and Neeraj is going to take lead in two of us. And welcome guys on board. And as I believe that practicing a CPA, but chartered accountancy is, I value chartered accountancy way more than CPA. Thank you guys.
Great. Thank you, Neeraj and Sanwar. I did receive some feedback from some attendees that they were not able to hear, and we've done some tweaking. So I hope you guys can hear all of us now. In case you can't, do let us know in the chat window, and we will try to tweak something more. But with this out of the way, I need to make two disclaimers. First of all, none of us, me, Sanwar, or Neeraj, are providing any kind of investment or tax advice. We're merely sharing knowledge with friends. So if you do need some professional advice, seek out a consultation with somebody, either Neeraj or Sanwar or anybody else, and then take your decisions. And secondly, this event is being recorded and will be made available to open to public platforms. So please bear this in mind while asking and responding to questions. So guys, let's begin our journey into the taxes. Let me ask a very basic question. So what is the concept of residential status for taxation purposes? And how does that differ from the immigration status? How does change in residential status affect taxation? And what is the difference between resident, not ordinarily resident, and non-resident from a taxation perspective? And I know there were some changes recently announced last year by Nirmala Sitharaman in the Indian budget. So how do those changes really affect things? Neeraj, if you can start with that, that'll be great.
Thanks, Nilesh. So first of all, let me start with from the US standpoint. Basically, here, non-residents file the 1040 NR non-resident return, but anybody who's a resident files the 1040 return. And now, what is a resident? Resident is not as per the immigration, but as per tax standpoint, which means if somebody has lived in India, in the US for 183 days or more, he files a return as a resident, and he's considered a resident. So that's the substantial presence. Basically, it's a citizenship or green card or physical presence in the US. And one of the things is that either you've been present in the US for 183 days or more in the current year, or the taxable year, or the 130 days, 83 days are counted with the number of days of present, minimum of 30 days in the current year, plus 1/3 of the days in the prior year, plus 1/6 of the days in the year before. If all these put together add up to 183 days, you're still considered resident based on the substantial presence test. There are special rules in the case of people who are moving to the US or moving out of US. Basically, that those are considered dual status residents. So there are special rules which are applicable, so they can file a split year return. There are certain categories of individuals who are exempt. Basically, as we all know, F1 students are considered exempt as non-resident, even up to a maximum of 5 years. Then there are J exchange visitors, or M, or cultural exchange, Q visa, or categories like these. So, and some diplomats and all. So they are, even if they are living here throughout the year, they are still considered non-residents. Now, coming to the India side, India has a different way. One is that somebody who lives in India for 182 days or more than 182 days, they are considered resident. Then there is another test is they have to live for 60 days during so mind you, in India, the year is April to March. Here we are using calendar year. So when we talk of the year in India, it is they call it the previous year, or the financial year used for relevant purposes. So that is, it is either more than 182 days in that year, or 60 days plus 365 days during the prior 4 years. Now, that 60 days was increased a few years back to 182 days for people who are working outside India. So, or they are members of the crew and all. So, in there are certain categories. So, if they are visiting India, then that was increased to 182 days. The change which happened last year in the finance sector in India is that 182 days was reduced to 120 days for people who are living overseas if they have income from Indian sources of 15 lakhs or more. So that's where it really becomes, for people who are traveling from here, need to be careful. If they have substantial income from India, Indian sources in India, then that 182 days is reduced to 120 days, about 4 years. So, and then they also added one more category, though people living in US are not affected. It's basically those in Middle East, which is there. They added a category called deemed residency. So where it affects people who have more than 50 lakhs of income in India, but they do not have any place of residence. Basically, they try to the target, they call it stateless citizens. So though big people keep traveling all over one country to the other, hopping from one country to the other, just to avoid being resident anywhere, so that they don't have to pay tax, especially in India. So that they added a category called deemed resident for such to target such individuals. There was some tweaking in that definition. There was some clarification which was done in the very recent Finance Act in 2021 on that, basically. So now I think you had another question that what is the, so in India there are, here we have either resident or non-resident, but in India we have another category called not ordinary residents. So those people who become either deemed resident or become resident by because of the change in Finance Act announced last year, they are considered not ordinary resident. So there are 4 category of people who are basically there are the person to be a not ordinary resident, they have to be so that they don't fall into the category of a resident individual, then they have to be a non-resident for 9 out of the last 10 years, and their stay in India during the last 7 years should not be more than 729 days. And then they added these 2 categories which we mentioned, deemed residents, and also for those who have stay of more than 120 days. They also fall in the category of the not ordinary resident category. And why this is important, why this thing is important, basically is because the kind of income which can be taxed for people whose status changes from a resident to not ordinary resident. Basically, for non-ordinary resident, any income which is derived from a business controlled or professional setup in India is taxable in India. Then they have to report all the foreign accounts and like FBAR and other compliance. I'm sorry, I'm talking from the India standpoint. They have to report all the financial accounts and the investment which they hold outside India in India. And they may also have to redesignate their non-resident accounts, NRO, NRE and all in India as either resident accounts or resident foreign currency accounts. So those are the kind of impacts that we have.
Okay.
Sure.
Thank you so much, Neeraj, for that detailed explanation. Sanwar, would you like to add anything to it, or you're good?
I think Neeraj covered everything into that one.
Super. Let me ask the next question is that if I'm a US citizen and a green card holder, can I invest in Indian stock markets, and how can I invest? And what are the regulatory constraints that I should be aware of? And what are the taxation considerations? Neeraj?
Yeah. So if basically if you are having a green card here, or and then you are either have an OCI or an NRI in some categories, you can invest in Indian stock market. Basically, there are rules through under the portfolio investment scheme. You can invest basically, but it can't be exceeding more than 10% in the paid up capital. It has to be through a trading account, a demat account. There are certain restrictions which have to be followed. Basically, you can't do trading. There are restrictions on the amount you sell. You can invest in new IPOs, but then the onus becomes on the company which is raising capital to inform to do the compliance. But you can subscribe to IPOs also. So basically, yes, you can do, but there are with some restrictions.
Okay. And what are the taxation considerations?
Basically, when in India, those income is taxable in India as well. So because their sources is from India, in certain cases, depending upon where you are, there are certain cases depending upon your income also and your other involvement. There are certain in some categories there are treaty rates or non-treaty rates where 10% is there. So because we'll probably there's one or two other issues which come in because of some other changes which happened last year by the Finance Act, which I think we can cover later.
Sure. Yeah, there are a lot of questions on that too.
Yeah.
So let me jump on to this on the capital gains taxation part, and I think that's something which is of great interest to people on the panelists if I see the chat window. So let's talk about how does the capital gains taxation regime in the United States differ from that of India? What is the concept of short-term, long-term capital gains, India versus the US? And and this is something which impacts a lot of people, that if you own a property in India and you sell it, then what are the capital gains tax implications for India as well as for the US? I mean, if you could cover that, that would be great.
Yeah.
Property is something which everybody is talking about. Neeraj,
Yeah.
you can start with it, and then Harshwal, you can add to
it. Okay. So so basically, when anybody sells basically, yes, as you're mentioning, the issue comes up with the sale of property or even sale of any other capital assets or investments also. So one has to bear in mind the sources of the sale is India. Tax has to be paid in India, even for non-residents. And then we have to file a tax return in the US. We have to report the income also in the US. Now, for long-term gains, there are different rates, different rules which have to be followed in India and here. So essentially, long-term capital gains for stocks and mutual funds are normally taxed at 10% rate, and real estate and other debt mutual funds are at 20% rate with an indexation for real estate and other assets which are there. In US, we do not do indexation, but on the contrary, what we can indirectly take an advantage is basically use a different currency rate. So at the time of acquisition, let's say in 2005 or something, the dollar was around $40 or something, $45. So we use that rate then, and we use a different rate now. So that indirectly gives a benefit of indexation, though not to that extent, but depending upon the devaluation of rupee versus dollar during this time. So, and here long-term gain is more than 1 year. Besides the indexation, there are broadly this, but then there are some tax saving options which are available both in India as well as in US. but they are different. So one has to really plan in advance and see how they can take the maximum benefit of both the tax regimes. So in India, like you can do, if it's a residential house, if you can buy another residential house either 1 year before or 2 years later, or you can invest in certain rural electrification bond, National Highway Authority bonds up to 50 lakhs, but the money is locked for 5 years over there. And thirdly, now if you already have the capital gains, you can invest in another residential property. They've allowed up to 2 properties you can have in India. So those are the ways in which you can save tax in India. In India, when we come to US, so you can't just take decision, just okay, I've saved tax in India, and now I shouldn't be paying tax in the US. That is not the case, because here that amount may still be liable to tax in the US. So when you're selling, let's say, I'll give you an example. There are a lot of clients come to us. They've already sold the property. They said we have invested in REC bonds, and now we are not liable to any tax in the US. What happens here? I said, now you have to pay tax here. So you would lock your money. You don't have liquid cash, yet you have to pay tax in the US. Whereas if they had not put in those bonds, they would be paying tax in India. They can get a credit for the tax paid here. So with the same money, they're paying the same tax, yet the money is not blocked. So, but that's one example that may not hold good in all the cases. So what happens in the US is basically there are other options we have for tax saving, like one of them is we of course we calculate based on indexation, different currency differential we use. Then here, if the property in India is used as residential property, you can take, as we all know, if you've lived as a primary home for 2 years out of the last 5 years, you can exempt gains up to 500,000 for married or 250,000 for a single person. Another interesting thing is that in the US, inherited property, we use a stepped-up basis. That's not the case in India. So that's an advantage we can have in US. If somebody is living here in California, it's a community property state. Again, when the spouse passes away, also there's a stepped-up basis we use here. Then we have another interesting thing we can do is in both the cases we can take advantages of 1031. Although there are challenges, you have to meet the requirements at both India as well as US. 1031 can also be used but you can sell a property in India, but you have to buy another property outside the US, not in the US. So, but you can still do buying another property so long as you can satisfy the 1031 requirements. Or tax deferral through recently, which has been announced, opportunity fund investments, those also are available. So in such cases, so these are some of those options which we can see. Plus the tax rates, of course, are beneficial for a long-term rate. Up to 80,000 for married filing joint, there's no tax if the total AGI is below that. And then from 80,000 to about 500,000, it's a 15% rate. Then it's 20%. So basically a calculation has to be done and see what is the best course in such a situation.
So I'm seeing a lot of questions popping up about property, and different people have different circumstances and how the property gets inherited. So I would recommend that you need to consult a proper CPA with the specific facts of your case. And what Neeraj is saying today may not be applicable to all the situations. It depends upon what is your unique circumstances. Having said that, before I move on to other topics like PPF and mutual funds and stocks, which I'm seeing coming up on the Q&A chat, there's one question from Suresh, which I think is very topical and relevant. He's asking a question that there have been some recent news and rumors that NRIs and OCIs cannot sell real estate property in India without the explicit RBI approval. Is this true? Has anything changed recently? I guess he's referring to the Supreme Court decision. Sanwar, Neeraj, either of you can respond to that question.
I think I will attempt that question and then Neeraj will support me. So that Supreme Court, I have also gone through that Supreme Court case. I read that, and that case is very specific case, and that is really, really not applicable to the FEMA. The recent changes made by the new government in 2018, they have the specific provisions to deal in the properties. And so that Supreme Court case is really not applicable to the current situation.
Neeraj, you want to add something to that?
Yeah, I think Harshalji is right. It is not applicable because I think what is also causing confusion. This is again, in my opinion, because I think we are still awaiting clarification from government specifically on this. But my assessment is this case is at the time when FERA was there, Foreign Exchange Regulation Act, which was replaced by FEMA in probably around 99, 2000. So
Correct.
There were restrictions in FERA, but when FEMA came in, then they have specifically allowed NRIs and OCIs to invest in properties, and now they've also clarified there are restrictions only in terms of investing in agricultural land or plantation properties and certain restrictions. Other than that, NRIs have been specifically allowed to invest in properties. So that basically the case was an old case at that time, so which is causing the confusion.
So if a property was purchased at the time when FEMA was in place, I guess that is the FERA was in place is what somebody needs to worry about, right? Other than that, and which is pretty old, right? Almost more than 10, 12 years ago. So most of the people buying properties now would be completely okay. Is that a fair assumption?
I think I would say yes, but I think we still need some clarification on this. That's my assessment, because even I was hearing the Consul General also. He was also not saying that we are awaiting for further exact clarification on this point. But my assessment is under FEMA it's specifically allowed.
Okay. So I'll move on to some of the other aspects of like Amol has a question. Is PPF considered retirement benefit in the USA, and are PPF proceeds taxable in US? Similarly, somebody's also asked question about LIC maturity proceeds. Either of you can take that question. PPF and LIC maturity proceeds. Are they retirement benefits in the US? I mean, are they taxable?
Sanwar, you want to take up or?
Yes, so the PPF is PPF, and if I can talk both of them, and Neeraj can really substantiate my answer. So the PPF and the LIC proceeds both will be considered as the other income in US. So both will be taxed in US based on your residential status in the US. And in the US, but we are talking about the LIC, particularly the life policies in India. So that's the tax position in the US. Now, Neeraj, you can really kind of give your 2 cents on that.
No, I think Harshalji is right. That will be taxable here. The only thing is what we can reduce is the cost basis, how much was invested in that. So basically, so that the gain is taxed here rather than the whole proceeds, because you're already putting in some money. In any case, if you see the LIC in India, mostly what we have is the annuity type. Annuity type of insurance are taxable to the extent of gain in US also for US policies as well. So it's only pure term life which is not taxable here. That's again in a very simplistic way of a more complex and complicated kind of a scenario.
So Nilesh Sangoy has a follow-on question where he's talking about that, do we need to accrue the PPF interest on an annual basis?
Not really.
Okay, great.
So,
Neeraj,
I can add basically for certain clients what we have been doing. In some cases, if they client wants, we have sometimes been accruing and treating like that year-wise it is there, so that then at the time of sale, we just take a stepped up the cost they are added and reduced from the gain at that time. So yes, but as Harshalji mentioned, we don't have to do it, but IRS is not very categorically in many cases clearly defined this. So they themselves suggest that you call them and get a clarification. But what I would say that you can, if you're not taking, then at the time of disposition, you need to pay the entire on the entire amount. And if you're accruing and reporting gain on a year-wise basis, then you just have to pay it. Don't have to pay it the entire amount.
Another important avenue of investments that people in India look at is mutual funds and gold. So we'll take a couple of questions about that. So Amol has a question that is gold an investment option between India and the US? And what are the implications of sale of gold in India? And where is it better to hold gold? You guys want to have a crack at that question? Either of you, Sanwar, Neeraj, whoever.
Ashilji, you want to answer?
I won't be able to.
Yeah, okay. So Neeraj, maybe you can talk about gold.
I would say that it's like any other investment. You're selling and it will be taxable here. But I mean, obviously, which is better is anybody's guess where the market is going to be there. Generally, the prices are comparable. Of course, whatever is the differential it's there. So I think that's individual call. What you are expecting, whether gold will be better, or it will also in terms of which appreciates more, the dollar versus rupee or gold. So it's I mean it's anybody's it's a speculative decision. Whatever you feel.
That's $1 million question, right?
Yeah.
So, and similarly, a question about the mutual funds. Tejal has a question that, can you invest in Indian mutual funds? And can you explain how the reporting is done in the US, specifically PFIC rules and Form 8621 reporting in the US? Neeraj, you want to take a crack on it?
Yeah, it's basically the PFIC reporting adds up to a lot of complications and because of that, it's in the news. So basically, the IRS expects that if your investment in mutual fund, which is PFIC investments, is $50,000 or more, they should be reported in Form 8621. And essentially, there are multiple reporting requirements. One is FPAR, it has to be reported in FPAR. Then you may have, if you're a single and you have investment of 50,000 or more, or if you're married, then more than 100,000 at the end of the year, you need to file 8938. Then comes the Form 8621, where you need to report the gain. And there are special rules. It's quite a detailed form. There are 2-3 different ways in which you can do it. So either you can do as a mark-to-market, or if you don't do as a mark-to-market, then at the time of sale, you need to report the gain, which is a very sort of, I think 1291 calculation is there. Basically, let's say you are selling a mutual fund which was acquired in 2012, and you're selling it today, and you didn't report them on a mark-to-market basis. So basically, the IRS expects you to allocate the gain over all these 8 years, apply the highest marginal rate of tax for each year, and calculate interest also on that amount from all the years. So part of it will go into 2012, you calculate the tax, add the interest. Part will go in 13, you calculate the tax and add the interest. So, and that exercise you have to do for each and every mutual fund. So you can imagine why people are really it has become a dreadful topic or subject, because it leads to all these complications, both in terms of calculating the tax and reporting.
Absolutely, absolutely. And Jayaprakash has a relevant question, and maybe he's asking: does FBAR filing mandatory in the US during tax refund? So when you address that question, it would be good to sort of explain a little bit about what is FBAR and what are the documents and tips and tricks that you need to be careful about when you're compiling your FBAR, form. So either of you can tackle the FBAR. Sanwar, Harshwal, either of you.
I will. I can take up.
Yeah,
but
sure.
at least start answering it. So the first and foremost, the FBAR reporting is mandatory. There is no escape of not reporting. That option is not at all there. And I don't think there are any tricks or available to really kind of circumvent anything. That's also not possible. Now, when we have, there are 4 or 5 categories. If you have the money in the bank, if you have the surrender value of the life insurance, if you have the mutual fund, there are 4 or 5 categories. If any day throughout the year, if that balance exceeds $10,000, we are required to file the FBAR. There is, as per my understanding, there is no way that we can escape that part. For the evidence, our bank statements or any statements substantiating the documentation about that, let's say insurance policy, surrender value, or statement of the money in the mutual funds, those will be the evidence. But so where we file the BIR on the US Treasury on the online. It is not necessary to file it with the tax returns. It is a altogether separate item to be filed, separate compliance requirement. So that's what I understand. I think Neeraj can add something to this.
No, I think you're right, Harshalji. But there is also another, besides the FBAR, if the balance at the end of the year is more than $100,000 in the financial accounts, or more than 150,000 at any point of time for merit filing joint, then you also have an extra reporting of in Form 8938 FATCA reporting. Now there are certain items which are reportable in FBAR but not in 8938. If you are signatory in somebody else's account, you don't have a financial interest, but you are a signatory. Let's say it's your parents' account and they have added you as a signatory. You still need to report that also. Or you are a signatory in an entity over there. You still have to report in FBAR, but those may not be reportable in 8938. But on the contrary, in 8938, there are certain reportings like if you have investment in shares directly, those are reportable in 8938, but not in FBAR. And there are other examples like that. So, as Harshwal mentioned, we all have to maintain financial records. These are the evidence is available from bank statements, from investment account statements, and things like that. LIC surrender values, cash values we can get.
Correct, absolutely correct. So, and you mentioned the dreaded word FATCA. I mean, that word sends shivers down the spine of a lot of people. So, on that, there's a related question from Nilima Shukla Bhatt, and you can cover FATCA with this question because I think they're related. If a person had income in India that was taxed in India at the highest taxation rate of India, and the income was not brought into the US in the sense that it remained in the Indian banking system, how would it be treated in terms of IRS taxation in the US? This has the whole element of FATCA in it. So why don't you cover it with FATCA?
I think it will be taxed definitely in the US. So far taxation is concerned, it will be taxed in US. And if you have paid the taxes there, then you can take credit here. So far taxes are concerned, now reporting in the FATCA, I think Neeraj can shed light on that.
No, first of all, see, it's your bank account, whether it's in India or US. US wants their pound of flesh. Your income anywhere in the world, they have to pay tax. Whether it's in India, in your account, what kind of account, it doesn't matter. You're moving from India to your account in India to your account in US. That's not a taxable thing. The moment you earn your accounts, whatever they earn, you have to pay tax, whether it's here or in India. The US doesn't make a distinction on that. So and they, from moving from your account from there to here is not reportable, but income is reported. The balance accounts are reportable as per FATCA, as I mentioned in Form 8938. If the balance is for individual, it's more than 50,000, and for more than 100,000 for married filing jointly.
So maybe when you're talking about FATCA, also this is the time to also talk about the double taxation avoidance treaty, DTAA, as to what are the benefits that are available for income that is generated in India and taxed in India, and if it's reported here. I know you covered it a little bit in another question, but since for the sake of completeness, if you can talk about the DTAA too.
So if the tax is paid in India, then you get a credit for the tax paid in India to the extent of the amount which is calculated on that income in US. So in a simplistic way, let's say your tax rate in India is 20% and in US it's 30%. So you'll get a credit to the extent of 20% and you pay the differential here, 10%. But if let's say you're paying in India at 20%, here your tax is only 10%, you'll get a credit only to the extent of 10%. What is your US tax calculated on that particular source of income? This is in a very, very simplistic way, because the calculation is far more detailed. A lot of elements go into the calculation of the tax, but in a broad, simplistic way, that's the principle which is there. But credit is only in the federal return, not in state returns. So you basically have to pay tax in the state on that amount.
Yeah.
So without any credit.
Correct. True. So just a request to all the people on the call, try to put your questions in the Q&A box because I see some stuff coming on chat as well, so it's kind of getting missed. So put it here in this, that'll be easier. There is one final related question on the PPF. Somehow that's like very interesting to the crowd. Rakesh wants to know any minimum or maximum amount taxable in PPF, or any amount is taxable. And how about in India? Do we have to pay tax in India as well? Do you want to take that question, Neeraj or Harshwal? Whoever wants to do that. Is there a minimum amount or a maximum amount?
No, I have no idea about that. Neeraj, you can take it.
So in India, it will be normally provident fund, so long as you're complying with the rules in terms of withdrawal and a minimum amount of saving for a specific number of years. It is exempt, but in US, it will be taxable. And any amount is taxable. There's no exemption as such on that. So if you have gained, it is taxable.
Okay, so there is another question which is relevant in some ways. I don't have a name. The person who asked this, but it's important. What is the best way to repatriate money from India in case of property sale or sale of equity? So I don't think just the remittance creates any taxation incidents, but I'd happy for you guys to respond to that as well, because this is something which keeps on coming up. Neeraj?
Yeah, okay. So when basically you're selling a property, basically you pay tax in India. So there is you can get a tax clearance certificate from a CA in India. So we normally fill up form 15 CA and 15 CB. That is submitted online. Basically, the tax department as well as the financial institution can access those. And based on that, money can be transferred. Normally up to $1 million can be transferred with that. Other than that, There's a liberalized remittance scheme up to 250,000. It can be done. So those are the ways they can be transferred here. The money can also be transferred from an NRO account when you're selling to NRI account, and then you can transfer it anytime. So again, using the same the certificate from a CA. But remittance, transfer of money from India to US normally should not, it by itself is not a taxable event for US purposes or for India purposes.
So one relevant question that came up on this remittance part is, again, I don't have the name of the person who's asking it, but it's relevant. It says that when I invest money in India by transferring dollars from US at currency rate of 40, I would love it if I was there, and sold recently, and recently at a high price in rupee terms, but lower in dollar terms, am I liable for tax in the US? So in this case, the act of remittance, does it create a foreign currency gain tax for? I guess that's the question.
I thought there was a loss in there. You transferred at $40 and now you're getting back at 72. There's a loss. Actually, we have taken the loss in some cases where there has been a substantial.
And if it was a reverse?
Well, it's very rarely the case. Yes, then you have to pay tax, but which is very, very rare. There was probably in the early 2000 to 2005, this thing happened, because at one time, I think the rupee appreciated to 39 from almost 46, 47. So that was the very rare time when it was there.
So Hina Shah has a very interesting question, which I think is relevant to everybody. How is jewelry inherited from India treated in US? I assume that she's talking about jewelry which is inherited and sold. Sanwar, you want to answer that?
I think if it is inheritance, then I think looks like they have to, for the cost purposes, they have to use the index. But the sale proceeds will be definitely, there will be capital gain tax if it is, even it is an inheritance when you are selling it. But so far the cost is concerned, I think they can use the indexing. The inflation index is really published by the government of India.
But I guess in the US, they probably will have a step up cost basis, right? On the date, the cost would be.
Well, if it is inherited, that's if they're getting by inheritance, yes. But if they're getting as a gift, no. So basically, as an inheritance, there is a stepped up basis. And also when you were getting that, there is if the value of the inherit is more than $100,000, there is another reporting which may have to be done in Form 3520. So for overseas gifts.
Yeah. Prajakta has a question. What if we have investments for kids in India, like mutual funds, on maturity or withdrawal? Will those be clubbed in parents' US income? Now this is a completely new thing, in terms of clubbing concepts in India versus what happens here. So, Neeraj, you want to tackle that whole concept of clubbing there and not here and stuff like that?
Basically, what we have to look at is the rules in the US of the kiddie tax, where the children are under 14 and the income is below threshold, I think. So those are the ones which we have to look in. And they have only that income. So that if they fall within that, whether they are in India or in US, if kiddie tax rules apply, they will be there. So those are the ones which, in those cases, they are clubbed. Beyond once they are beyond the age of kiddie tax, then it doesn't matter.
More, I'm seeing the chat, the Q&A window, and the number of questions that are coming up on FBAR and FATCA. I guess I should have created this session, not NRI taxes, but all the things that you wanted to know about FBAR were afraid to ask. I mean, that would have been the right title for this seminar. So Amol has a question: is PPF to be declared an FBAR? I guess you have to disclose everything, but I'll allow the expert panel to answer. I guess the answer is yes, right?
Yeah, I think both of us have already answered.
Yeah, I know. I guess so. We'll probably skip that one. Jay Prakash has a question. In case of LIC, does the premium paid per year need to be shown in FBAR, or the insured amount is shown in the FBAR?
Surrender value.
Yeah, neither of the two, but as Harshwal mentioned, the surrender value.
Yes. Yeah. What is the deadline for FBAR?
I think.
Actually, it is 15th April. They have not extended. They have IRS announced 2 days back that there is no extension for FBAR filing, but there is an automatic extension normally, which is there. But they have not extended the FBAR. It is 15th April.
Okay, so while your tax filing date has changed, the FBAR requirement is still 15th April.
Yeah.
Okay. Well, something relevant and interesting. How does one treat the money received under COVID relief if the person has already moved to India and does not require to file return to USA this year? A unique case. Do you want to take a shot at that?
Harshwal, you want to start?
Can you repeat that question, Nilesh?
How does one treat the money received under COVID relief if the person already moved to India and does not require to file return in the USA this year?
Yes, still they have to file the tax and report it.
Okay. Okay. I'm just trying to scroll through that and come up with more questions which have not yet been answered. Bhavesh has a completely different question. So let me take that, which takes us away from FBAR and FATCA. If an Indian wants to do business in the US, what are the advantages, if any? And is there any significance to register an entity in Delaware or Nevada? Does the entity need to have a principal place in that state? So an Indian who wants to do business in the USA, should they do Delaware or Nevada, and do they require a principal place? So, Sanwar, you want to answer that question?
Yes, they will require the principal place for sure. Regarding making the choice between Nevada or Delaware or some other state, maybe New Mexico, is dependent on the kind of activity you want to get started in. They are the state, they really, particularly let's say this Nevada and Delaware, New Mexico, and there is one more state. Those 4 states, they are really debtor-friendly state. We call them the debtor-friendly state. They are not the creditor-friendly state. So that's not really a tax question, but if our business activities are in such a way that tomorrow there may be some creditors or some other regulators are coming after us in so many different ways, then we need to have those, because most of the Fortune 500 companies are registered in Delaware.
Okay. Neeraj, you have to add anything to it?
No, I think Harshwal covered it well. The only thing is basically if they're having physical activity in a particular state, they may still have to register as a branch there, because a lot of times people just ignore that part. They incorporate in Delaware, they start active. We see that all the time happening in California. People operate here and suddenly they use the address, and California franchise tag would start sending them notices. Where is our return? Because you're operating here. So that most of the states want, if you're where you are physically operating, at least get a certificate of authority to operate there.
So guys, we are at 1 o'clock. We were supposed to end now, but I see an overwhelming list of questions just flooding the Q&A timeline. And so I'll take the liberty of extending it by about 10, 12 minutes. I hope you both are okay, Neeraj and Sanwar.
Yeah, we are okay.
That's fine.
Okay, great. So there's a question, is there an estate tax in India, and how can assets be transferred from parents to kids after death?
I will start, and then Neeraj is going to close it. I know that. So
Okay.
there is no inheritance tax in India. Just like here, there is a estate tax. There is nothing in India like that, and money can be transferred easily. There are limitations put by the RBI how much money should be sent in particular year and how it should be sent, but there is no tax. Now, Neeraj, you can add it. Or
No, I think Harshwalji is right. There is no, it used to be there till probably mid 80s. Then they abolished the estate duty they used to call. And, but yes, but for somebody who's inheriting, they still have to see the person, if the person giving is in the US, like your parents have also acquired green card and they're also here and you're inheriting from them and the properties in India, you may have to consider it. It may still be liable to estate tax in the US for the property in India. So, but if you're within the threshold, then it doesn't matter. Like for individual, because as of now the threshold in US is very high, which may come down under Biden administration. So
True. Another question which is different, and therefore I want to take this up, is that what are the capital gains tax implications when a US tax resident moves back to India? Do you want to take that?
Tax in US or in India?
Both. I mean, what happens if a US tax resident moves back to India? So do they need to plan for anything? What are the challenges around that?
I think the tax rates will be dependent on their residence status. But if the capital gain tax is really, let's say somebody moved to India permanently and the capital something sold in US is going to tax that here. And wherever we have the double taxation treaty, both the countries really have the provisions to tax the global income. So, and I think Neeraj can add to that.
yeah, I think you're right. The other thing which probably it's not the capital gain as such, but just because you move from here to India, there is any tax of capital gains. But there could be if for moving, if you're technically they called it as covered expatriate, so there may be a tax because of that. For moving over there are certain exemptions which are there. If your income is up to more than 172,000, then you may be there. Your net worth is more than 2 million at the on the date of your expatriation. If it is below these threshold, then it doesn't matter. Otherwise, you may, if you don't follow, you're not in compliance with those things, there may be sort of a repatriation, your own tax for your moving out. For relinquishing your US citizenship or green card. So it's a very detailed subject, but I'm just covering in a very nutshell.
Yeah. I mean, this is definitely a very complex situation.
Yeah.
And you did cover it indirectly when you were talking about the residency status and how that has changed significantly over the years. There is one other different question. I thought Sarvan has asked this question. When we have interest income from deposits in India, can we adjust the income for loss or gain in currency rates and offer the net amount to the tax in US tax return? Or do we need to offer just the interest income? Also, if the gross interest income, that is without the exchange loss, is taxable, is there a way to claim that exchange loss in US return?
I think Neeraj can.
Neeraj?
Simple answer is yes. Yes, we normally it's a very small insignificant amount. We ignore it, but we have if it's a substantial loss, we have been doing. And actually, in some cases where I think the threshold is more than 50,000, then there's a special reporting to be done, which we have done in the for where they have big deposits in India, and there's a big currency loss. And of course, in the last couple of years, it's been very gradual. But there were times in 2008, 9, 10 when the currency depreciation was really substantial and the losses were pretty significant. So we can take the loss. And if I think the amount is more than 50,000, there are some extra reportings to be done. Some special forms have to be disclosed that this is a special loss you're taking.
Okay. Anil has a question. How is rental income from Indian property accounted in the US? As per his understanding, a tenant can and will deduct 30% tax from the total rent if the owner is an NRI. If the total income for the owner in India is more than 2.5 lakhs. He wants to know whether that still is the case.
I think the tenant will deduct 30% tax on the rental income.
Is there a threshold of 2.5 lakhs is the question.
So there are rules for TDS over there for those, but you can take a credit for the tax which has been paid in India, or you can file a return in India and claim a credit for the extra tax which has been withheld. So basically, once your income is actually more in India, you have a substantial rental income. It's better to file the return there and claim if there is an excess amount withheld, you can get a credit. And whatever tax you pay finally, you can get a credit in the US also. But one more thing which is there is the way rental property is taxed in India is different from here, because the expenses which are claimed, there is a flat 30% tax deduction allowed for repairs and collection cost. Whereas in US, we take on an actual basis. So we just don't take a flat blanket 30% deduction. So yeah, those adjustments need to be made for reporting here in the US.
Talking about reporting, Bipin has a question that is PFIC filing required even though mutual funds in India are not sold. So,
yes, I think we answered that in Form 8621 that is required.
Correct. There's another question. If you become a resident of India and non-resident of the US, and you are a US citizen and spouse is green card holder, do both have to file taxes in the US? You become a resident.
Sorry, can you come again with the question?
Yeah. If you become a resident of India and a non-resident of US, but you still remain a US citizen and the spouse is a green card holder, do both have to file taxes in the US? I mean, that goes back to the first question we asked about taxation and residency status. So the answer is yes, but
yeah, because both have a filing obligation. One is a citizen, the other is a green card. Both even if you're not physically here, that is one of the conditions besides the physical presence, because both green card holders, even if you're not living here, you have to file in US. If you're a citizen, you're not living here, you still have to file. And it is better to file jointly.
Correct. On the jewelry part, there is one question where if we have kept our jewelry that we got as a gift in India itself, that means they're not physically brought that here. So when we bring it to the US, is there a taxable event at any point? Does the mere act of bringing the jewelry back to India, does that create a taxable event? That's a question from Kumar.
No, that is, it's your own things you're bringing. Maybe at the time you were getting the gift, you have purchased jewelry yourself. No, it's your own things you're just bringing.
Correct. There are some very specific questions. I'll skip those because those are relevant to the individuals. Can a US citizen inherit agricultural land in India? That's a question. Not entirely tax related, but it's relevant nevertheless.
Yes, US citizen can inherit but cannot buy.
Correct. Mr. Can proceeds from maturity of investment of long-term capital gains in bonds under Section 54 EC be used for any purpose, or does it have to be used for a purchase of new house in Section 54? Neeraj, you want to take that?
Yeah, I think I covered basically. Then you need to see what it is for India. It has to be for those. There are three conditions which are there. So if you meet one of those three conditions, either it's a residential property bought within 1 year before and 2 years after on say sale of property, or in RAC or NHAI bonds, or you're acquiring now. They have allowed the second property for any capital gains. You're investing there. So those are the three things in India. And then you need to see whether one of those things which I mentioned applies in US as well.
I have a lot of questions still unanswered, but we are reaching the end of what we agreed was our time. So before I close out, I want to check if Neeraj or Sanwar, do you have any comments to make in closing?
I'm really appreciate you and Neeraj both, because you really did good. I want to admit that. And the comment is that regarding those questions, my suggestion is this one, that I mean, if you have another platform for those questions, I would be happy to answer those questions. Because so many people, I mean, the response is really good. So I will be able to answer those questions. And if I'm not able to, then I will definitely pass on those questions to Neeraj. And so Neeraj is the expert one here. But if you have any other platform, we will be happy to answer those questions.
Sure. Neeraj, you have any comments?
No, I think these were interesting questions we got from the audience, but the way things are, the way taxes both in India and US are changing, like in India, a lot of changes which impacted here. One of the change last year also was in terms of change with the tax on dividends in India, because if you recollect, in India it used to be dividend distribution tax, which we were not getting benefit of that tax in the US. So although there was no tax in India, it was at the company level. So last year they changed from dividend distribution tax to levying the tax at the individual level. So if anybody pays tax in India, now we can get a credit here. So likewise, there are changes which keep happening both in US and India. They have impact here. So one has to really look at everything, and we have to be abreast of things which are happening in India also, because especially for people who have investments there and come from overseas. So it was really a good, interesting session. A lot of interesting questions. I want to thank you.
We answered, thank you for answering almost 40 odd questions. But we still have 20 questions, 23 to be precise, unanswered. And this way we can spend the whole Sunday talking about various intricacies. But I guess we'll have to call it a day, unfortunately. All the questions that you guys have posted but not yet answered, we'll figure out a way to address that. At this moment, I don't want to commit anything because some of this are very specific situations. So we will, maybe we'll have a follow-up session or something like that where we can cover those and other questions. With this, let me thank you all once again for joining us. I want to thank the entire management team of the San Francisco chapter for arranging this. I also want to thank the sponsors of the chapter, and I want to take their names. It's Eisner Amper, Anand Bhavan, Sanjeev Gupta CPA, Chug, AppWrap, Bhatia and Company, Harshwal and Company, Right Comply, or Right Co. These guys have all stood by the chapter, and they've been a great support. Thank you to all. Thank you, everybody, for patiently being online, and apologies for the people whose questions were not yet answered, but we promise we'll come up with something to resolve them very soon. With this, thank you, Neeraj, thank you, Harshwal, and thank you, all of you, for a great session.
Thank you.
Thanks, Nilesh. Thanks to ICAI San Francisco chapter. Thanks to all the participants for spending your time on a Sunday afternoon.